Let's take a look at NIO stock and what's happening ahead of their upcoming report. We will try to determine where the price might go next based on volatility. We will also examine historical and implied volatility, look at the support levels of this stock based on derivatives, and I will show you a 3D volatility market forecast. Additionally, I will present a strategy that can help you profit from both the upside and downside movements of this stock, meaning we can make money from both the rise and fall of the stock. Let's start from the beginning. Over the past month, the stock has risen by 65%, which is quite significant. It has now hit some resistance and has been consolidating at the same level for 20 days. With just over a week left until the report, let's take a look at the options market and see what's happening there. As we can see, volatility has significantly increased during this rise. Volatility increases not only during the stock's decline, but also during its rise. Any stock movement increases volatility, and we will definitely play this as well. After a sharp rise, volatility increased, and then the stock entered a sideways movement, causing volatility to gradually decrease. Currently, it has settled at around 80%. Let's also look at the volatility smile. We can see that for nearer strike prices, volatility is rising for both the downside and the upside. This means traders and investors are anticipating both a rise and a fall in the stock. However, if we look at longer-term expiration dates, we see that volatility is increasing only for the downside, i.e., put options. This is logical because investors hedge their stocks by buying put options, and put options are generally more expensive than call options, which is a normal situation. Now, let's look at historical and implied volatility. At the moment, historical volatility is represented by the gray line and implied volatility by the white line. We can see a huge gap of 10% between them, and we can exploit this gap to make a profit. How can we do this? As I always say, you can make money not only on the asset itself, for example, by buying and selling stocks, but also by trading volatility. To profit from volatility, we need to use derivatives, specifically options. Let me show you how to play the decline in volatility. It's often easier to make money on volatility because it tends to revert to its historical mean. While we don't know the direction the stock will take, we can reasonably predict that volatility will revert to its historical levels, meaning it will likely decrease. Let's see what strategies artificial intelligence suggests. Let's say we want to develop a strategy for August and predict that volatility will drop by 20%. We are given several strategies, and one of them shows almost 91% profit potential. Let's take a closer look at it. This strategy involves selling a put option with a $5 strike price and selling a call option with a $6 strike price. This is a classic strategy known as a short straddle, where we sell both a put and a call option, betting that the stock will remain relatively stable and volatility will decrease. If the stock stays around the current price and volatility drops, this strategy can indeed be profitable. However, it comes with significant risk. If the stock price moves sharply either up or down, we could incur substantial losses. Hence, I don't recommend opening this strategy without a thorough understanding of the risks involved and the ability to manage the position actively. To make money with this strategy, you need to manage it carefully, selling and buying the underlying stock as necessary. Now, let's look at the trading volume of options, which is crucial. We see that a significant volume is concentrated at the $5.50 $6 strike levels. This explains why the stock hasn't broken through the $6 level despite attempts in early and mid-May. If you had been monitoring the support levels indicated by the options market, you would have understood this resistance. There is a substantial wall at the $6 level, which is currently unbreachable. A new wall has formed closer to the upcoming expiration date of May 24th, indicating short-term resistance. In summary, trading volatility involves understanding and using option strategies effectively. The short straddle can profit from decreasing volatility, but it's risky. You need to be able to manage the position and not rely solely on AI or other sources without developing your own deep understanding of the market. By analyzing the options trading volume, you can gain insights into support and resistance levels, helping you make more informed decisions. As we can see, the stock is struggling to break through the $5.50 zero. Additionally, there is a significant volume concentrated around the $5 level, which represents put options. This acts as a support level, explaining why the stock has also struggled to break below $5. By examining the options market, we can identify these support and resistance levels in detail, which is critical for understanding market dynamics. When you buy a call option, the market maker must sell you that option. This creates unlimited risk for the market maker, who then needs to hedge this risk by purchasing the underlying stock. This process, known as delta neutral hedging, requires the market maker to buy the stock according to the delta of the option. If the volume of call options surpasses a certain threshold, the market maker will have to buy a significant amount of stock, potentially driving the price up further. Currently, the stock is in a range bound by these support and resistance levels. A significant event, such as an earnings report or major news, could break the stock out of this range. High volume can overcome these support and resistance levels in either direction, but predicting this movement with certainty is challenging. I anticipate that the stock will remain in this consolidation range leading up to the earnings report. After the report, Depending on the results, we could see a breakout. A strong report might push the stock above the $6 resistance level, leading to potentially unlimited upward movement. In this scenario, the stock could gradually rise, possibly reaching $70 over time, with potential fluctuations along the way. However, it's important to emphasize that predicting stock price movements is inherently uncertain. My approach is to manage positions wisely rather than trying to predict exact price movements. This involves building a diversified portfolio based on mathematical analysis to ensure profitability under various market conditions. Currently, based on mathematical expectations and probability theory, buying the stock is relatively low risk, especially if you limit the investment to 5% or less of your portfolio. I recommend not allocating more than 10% of your portfolio to any single stock, regardless of how promising it might seem, as this is a prudent risk management practice. In conclusion, while the stock's potential for profit is high, so is the potential for loss. A well-balanced approach that includes careful portfolio management and diversification is key to minimizing risk and maximizing potential returns. Let's take a look at the 3D volatility chart. This chart consolidates all the information by expiration dates and strike prices. Professionals often use this graph to form strategies. Now, let's move on to a strategy that allows you to earn regardless of the market direction. As we can see, if the stock starts to rise and reaches $10, we can earn up to $12,000. Conversely, if the stock starts to fall sharply, we can also earn up to $2,000. This strategy has a small potential loss range between $4.50–$7, but this can be mitigated through proper management, such as selling options at closer strike prices. I'm demonstrating this as an example of how to profit in any market condition, but I don't recommend opening this strategy unless you can actively manage it. You need to be able to buy and sell options at the right time. I will be discussing this in detail when I start managing a new portfolio from scratch, where I will break down each strategy thoroughly. This approach aligns with my trading philosophy of investing by hedging my portfolio. I buy and sell stocks based on mathematical analysis, which consistently yields positive results. Let's also consider the market forecast. It's crucial to never overlook this. According to the market's prediction for August 2024, the stock is likely to be between $4 and $5. This indicates a potential decline by then. While the risk-to-reward ratio might be in your favor, it doesn't guarantee that the stock will only go up. A decline is also possible. Looking further ahead to the end of 2024, the market predicts the stock will be between $3 and $5. This wide range suggests uncertainty, but the market consensus leans towards the stock being lower than its current price. These forecasts are based on mathematical modeling and consolidated data from the options market. In summary, while there is a high potential for profit, there is also a significant risk of loss. Using strategies like the one demonstrated, you can manage your positions effectively and hedge your bets. However, it requires active management and a deep understanding of the market. Always consider market forecasts and use mathematical analysis to inform your decisions. We must not forget that this is a Chinese company, which comes with its own geopolitical risks. Besides the company itself, there are also structural risks, such as the possibility of sanctions being imposed by the US or China, either on the company, its products, or something else. This is something we must always keep in mind. I'm not saying it will happen, but it's important to consider this when building your portfolio so that you don't invest all your money in this stock. Additionally, I want to mention that very soon, at least I hope so, I will start my experiment from scratch. We will be investing and building a portfolio, and I will show you how to manage positions wisely. I have already prepared a spreadsheet where everything will be explained in detail, including how I buy stocks, dividends, and trading. Everything will be as transparent as possible, and it will be available to anyone at any time. I will launch the experiment as soon as I get monetization, which I hope will happen very soon. I have also recorded a video dedicated to the principles on which my portfolio will be built. You can watch it to get a detailed explanation. Subscribe so you don't miss the start of the new experiment. Good luck to everyone.